I think that this will resonate with the doctors. It was taxes. So I'm a technologist, data scientist. We earn massive W-2 salaries in Silicon Valley. I'm in Silicon Valley. And so you end up paying, you live in California, so you end up basically working for the man. You're not, you're basically an indentured servant of the IRS. So you start getting more and more frustrated, and you take that, irritation about taxation and tie it to my sacred itch, which is data analytics and the use of analytics. And what I found was that when I was using analytics and technology, I was making other people rich. When I took analytics and applied it in real estate, I've made myself and 600 investors rich, but I've also made 50,000 other people that don't invest with me rich by simply giving the analytics away. And so I was able to scratch the sacred itch and, not pay much in taxation. I pay very little in taxes at the same time. So I don't know of anything else that is this phenomenal from a tax avoidance perspective. And I really have looked. I've looked into crypto. I've looked into every other area. And from a taxation perspective, real estate is just ridiculous. I mean, there's an incredible bias here, and that's what dragged me in here. And so I was doing real estate for 10 years while I was doing, technology. And so I had a 10-year onboard and then 8 years since then. And so it's been great. What I found actually, and I think Annie will agree with this, is that the use of data in real estate is much more powerful than the use of data in technology, because there's 50 other guys doing it in tech. So the value is very low. But when you start applying that data in real estate, you're so far ahead of everybody else. Yeah, think of it as when I invest in Apple, I give Apple money, but Apple never tells me anything about what they do. It's a dark hole. I just throw my money in there, and then that's it. I never talk with Apple again. With syndication, though, most good teams, I'd say a vast majority of them, actually report in. Some report in monthly, some report in quarterly. So you get this feeling of connectedness. For example, this morning, we sent out a drone video of one of our properties that, has construction going on. And last month, we sent out about 35 pictures. So you get this sense of connectedness that you do not get with the stock market. And I really enjoy that because, you're not one of 10 million Apple investors, you're one of 40 or 50. But to step back for a second, why would you invest in other people's deals? I'm going to lead by example here, right? So I have a $500 million portfolio, 23 properties that we're building or managing. I've invested in 7 passive syndications myself in the last 3 months, 100K blocks in 7 other people's deals. And people are like, why don't you invest all of your money in your deals? The answer is, of course, I invest plenty of money in my old deals. It's required. General partners are required to invest hundreds of thousands of dollars in their deals. Point though is how the fact that I know so many awesome syndicators in the business, I know who they are because I've worked with them for years. I have an inherent advantage. When you invest in the stock market, you don't really know what's happening inside of Apple or Google. All kinds of bad stuff could be happening, but I know this industry well. And so I still feel that I should be investing passively. So I've invested in 7 different deals. I think 4 of them were multifamily. And then there was an ATM deal. There was a legal syndication deal. And then there was a self-storage deal. And so I'm spreading my money around still. So you never get to the point where you're like, I should only be investing my money by myself because I'm a general partner. No such point ever exists. If you do that, you're simply illogical. In fact, I think the number of passive syndications I will invest in will always increase as I make more money. So I think it's very important for people to understand this, that when they're like, should I do this myself or do it passively? I encourage you to do the deals yourself. It's a great thing. You learn a lot more. But that doesn't mean that your passive deals are going to shrink. If you're logical, they will increase. The one that I like the most with my 26 passive syndications is I tell them, randomly, alphabetically pick your, A, B, everyone's got names of their buildings. Pick 3 and send me the last 6 months of communications with investors. I find that some good ones don't communicate well. It's not like they're not good, but they don't communicate well. And so investors, that's a stressful investment. You might do well 5 years from now, but you don't know that today. So now you've got your stress levels going up high because they're not communicating with you. They're just worker bees. In today's world, I think that that's not acceptable. I think that those people are very old-fashioned, And I tend to avoid them simply because I don't want any stress. So I want a high level of consistent communication. Like our projects, all 23 updates go out monthly, and they're always on the 23rd of the month. Yeah, if it's if it's a weekend, then it's the day before that, not the day after. And that's something that we actually tell investors. That's our promise to you. So communication, I think, is very key. So I tell them it's a natural tendency. It is an illogical thing. And here's what I ask people to do. So it's like, okay, go back and look at your passive investments. Maybe you got some, maybe you bought, a single family rental, maybe you bought something like that. And tell me what you think was your net return from those single families in the last couple of years. And people give me a number. And I say, okay, I'm going to bet you $10, $100 if you want to, that your returns are 50% lower than what you just projected to me. Okay. And people constantly come back to me and say, hey, I did the math and you were right. How did you know that these returns were lower? The answer is, when people make their own investments, right, they're in charge. So they're not feeling that pressure from their investors. So they just accept whatever returns they get. They accept that this is okay. They accept that this is the way it's meant to be. And no investor that I know, including myself, I'm pretty anal, actually tracks their single families on a monthly basis, actually tracks their stocks on a monthly basis. And I would argue that if you actually don't track on a weekly basis, you're missing out on lots of profit. You're going to fall further behind market. You're not going to optimize. And so when I look at what people are making on their own portfolio, including my portfolio, I have a pretty large single family portfolio, my syndications have done better. Both the ones that I invest in and the ones that I passively invest in have beaten my own single family investments. Why? Because I'm not paying any professional level of attention, whereas I have 3 asset managers, 4 people in the development team that are asset managing existing properties and developing new ones, and they meet on a daily or weekly basis to manage those properties. So when you do something professionally, you actually do it better. So I encourage you as investors to actually go out and run this experiment. I would say 9 out of 10 of you will do better with your passive investments than with your actives. We just simply tend not to track that, especially because if they're not doing well, there's this desire to just kind of not track them because, that's not going to make us feel good. I also would suggest that when you're looking at sponsors, look to see that they're actually showing lower returns than they were showing in the past. And I think that's very important because every asset in the world at this point in time, and maybe we'll get a chance to talk about that, is more expensive than it was 12 months ago, 24 months ago, 36 months ago. So if a sponsor is actually showing the same projections in terms of, doubling your money or whatever, tripling your money, whatever it is, as they were 3 years ago, the only way they could do it is by gaming Excel, right? The returns are lower, but then at the same time, you understand that the money that you're putting in the bank is generating no returns. Obviously your 10-year treasury bonds are so much lower than they were 3 years ago, or 5 years ago, or 15 years ago, or 25 years ago. It's just been a constant decline. So I think that as a savvy investor, a logical investor, you have to understand that real estate returns are also shrinking. But from what I can see, actually, they're shrinking slower than other asset classes. So you have to understand the relative profit in real estate. So look for that, because I think that if people are not doing it, there's some Excel profits there, which are not real. So as a physician, you're not wanting for money. So look at syndicators and look to see what their average deal length is. That depreciation is an incredible benefit, but it's going to get recaptured on the day of sale. So it's better. Let's say you have 2 syndicators, they're both equal, you love them both. One of them, their deals last 3 years, the other one, their deal lasts 4 years. Well, as a physician specifically, the one with the 4 years is better for you because your money is going to stay in the deal for 4 years. You'll get depreciation for an additional 4th year, but even the first 3 years, you'll get that depreciation longer, right? And now essentially you have this tax-free money that you're investing for longer. So look for longer deals as a physician, simply because to you as a physician, you're building long-term wealth. You're not necessarily wanting for cash flow today. So that 3rd-year event is not going to, be the biggest event of your life. But if it can happen at the end of the 4th year, you've gotten another year of depreciation. every asset in the world is currently in a bubble. So we are in an every asset bubble, everywhere bubble. So you can choose to say, since every asset in the world, whether it's Bitcoin or real estate or stocks or land, is in a bubble, I'm not going to make an investment. That is one way of looking at it, and I'll give you my feedback on that. The other way of looking at it is, if everything's in a bubble, nothing is in the bubble, because if you normally, bubbles burst when one asset becomes worth a lot more than the rest of the market. So relative to the rest of the market, it becomes extraordinarily expensive, and the bubble bursts. Today, that isn't happening. And it's interesting because we've never seen this before in modern history, that all assets are going up. So for people who think real estate is worth 40% more than the beginning of last year, and they're like, this doesn't make sense. I have just one data point, and I probably have 50, but I'm going to give you the one that is the easiest to absorb. In January of last year, before COVID started, a month before COVID, Bitcoin was $7,000. Today, it's $49,000. So the question is, if Bitcoin goes up, and it's a speculative asset, correct? So if it goes up 7x, if investors think that COVID changed things so much that an asset that was worth 7,000 is today worth 49, by the way, it went up to the 60,000, so it's actually come down in price, then why would our asset class, which has gone up about 40% and has seen a massive increase in rents, like an unprecedented, never seen before. I've been in this for a long time, never seen the kind of rent increases that we've seen, March, April, May, June, and July. All 5 months were all-time record-breaking months in terms of rent increases. So we are actually seeing increases in rents, which obviously increases our profit, and we've probably seen a 40% increase in price. So from that perspective, real estate does not look expensive, or everything looks expensive. So on the everywhere bubble, all I can say is this: when every federal bank in the world is actively engaged in making the bubble bigger, it's harder for it to burst. Will it burst? Yes, it's inevitable. Will it burst quickly? I would suggest that you look at Japan. Japan started building an asset bubble in the 1980s. Hasn't burst yet, even though they've printed way more money as relative to their GDP than we have. So has China. So these bubbles are actually, they take a lot harder, they're a lot harder to burst than most people give them credit for, because the federal banks, who are in control of everything, every time they see that the bubble is at risk of bursting, they take steps to prevent it from bursting. So these things take a while, to go. I also want to give you one more data point. If you were sitting in 2009 and 2010 thinking this is a bad time to real estate, keep in mind we printed $2 trillion back then, $2 trillion. And we ignited a bubble that hasn't burst yet, but for 9 years until COVID started, that bubble basically increased real estate prices in a linear line, decreased cap rates in a linear line. There really weren't fluctuations at all. That was $2 trillion. We've just put in $6 trillion. So there's logical arguments that this bigger bubble, or everything bubble, has plenty of room to grow for the next 6 or 7 years. That is my hypothesis for my personal investing and for my professional investing. If you don't believe in that, if you don't think that that $7 trillion will actually blow a bigger bubble, get out of the market because it's too expensive. So when COVID happened, the stock market crashed and then picked up again, obviously, right? What you're looking for is volatility. So the stock market has this crash, goes down 30 or 40% within days. Bitcoin goes to less than half, like it goes to a fourth of what it is. In the worst month of COVID, nationwide rents on large properties fell 3.5%. Okay, so you have to understand the volatility of different asset classes when bad times happen. The stock market, 30% down in 3 days, Bitcoin down to a quarter, right? Rents in that month maybe drop by 3.5%, 4%, right? If you want to take the worst set of properties in the US, rents didn't drop 10%. And obviously the market corrected itself for stocks and for Bitcoin and for real estate. But what was the correction in real estate? 3 to 4%. So you have to understand that when volatility occurs, how does each asset class actually perform? You look at malls, still down 30%, right? A year and a half later. Understand how asset classes are different from each other.